Hello, my name's Andy Critchlow. I'm Head of News at S&P Global Commodity Insights, and welcome to the Look Forward podcast from S&P Global. In today's rapidly shifting markets, success depends on anticipating what's next. The professionals who excel are those who can spot emerging trends before they fully materialize. The Look Forward podcast delivers exactly that. Insights to help you prepare for tomorrow's opportunities and challenges. We bring you expert perspectives on macroeconomic trends, capital markets, energy transition, and global trade, with a sharp focus on what these developments mean for the decisions that will shape your tomorrow. This podcast connects you with S&P Global's Look Forward Council, bringing cutting-edge research on long-term trends and transformative market shifts. Together, we're committed to providing the forward-looking intelligence you need to navigate uncertainty with confidence. Welcome, everyone. My name's Andy Critchlow. I'm Head of News at S&P Global Commodity Insights, and I'm also the host of the Look Forward podcast. And on today's episode, we are tackling the subject of actuary in the US. As of 2024, the actuarial services market, yes, I can pronounce that correctly, in the US was valued at approximately $19.1 billion and is projected to reach $30 billion by 2030. And in terms of employment, there are around 24,000 actuaries working in the United States, filling a function in the economy that's absolutely vital, really, for the functioning of financial services and business as a whole. And to discuss this, I'm delighted to welcome into the studio here in London Stephen Smith, Chief Investment Officer of Insurance Investments at Neuberger Berman, responsible for advising, structuring and managing insurance portfolios across asset classes. In addition, Stephen chairs the C1 subcommittee at the American Academy of Actuaries, and I know that we're going to get into the Academy's work in a little bit more detail. So just to kick us off, what is the Academy, Stephen, and what's its relationship specifically with the National Association of Insurance Commissioners, and what's your role in that?
Sure. So the Academy is a nonpartisan policy group that provides technical actuarial advisory to policymakers. And you mentioned the NAIC, that's the National Association of Insurance Commissioners. So in the United States, insurance is regulated not federally, mostly at the state level, and the NAIC is where the different states coordinate on regulations. So among other functions, one thing the Academy does is advises the NAIC on technical and actuarial matters, and that's so in the scope of life insurance in particular, and that's where I volunteer with the Academy. I chair the C1 subcommittee, also the Life Investment and Capital Adequacy Committees. Those are both within the life insurance world. So I, with the C1 subcommittee work in particular, I'm helping the Academy on anything related to life insurance investment capital that comes up at the NAIC.
Just to kind of frame life insurance as a subject in the United States, I mean, is life heavily insured in the United States when compared to other developed economies?
It's a great question. It's so certainly the most heavily insured on life are going to be Japan and Taiwan. And actually, I think in reverse order. Taiwan is the largest life insurance market as a percent of GDP in the world. Japan is way up there. To be honest, I don't know how the United States compares to, say, the United Kingdom or other European countries. I mean, the growth. This is going to be important for kind of what we were talking about later. That there's been a lot of growth in the life insurance space, but really that growth has been in specific types of universal life and also annuities. Which all falls under the broader that broader life insurance umbrella, and it all gets regulated under that life insurance umbrella.
It's a fascinating subject, and it occupies a lot of people's conversations at the moment, either at dinner parties or at round tables. I was at a function in the city last week, and this whole subject of the changing demographics and more people, hitting that 50 plus age bracket, and of course life insurance, annuities. These are all services in the financial sector that people start to think about when they get older, right? And in economies like the United States, in Europe here, the UK especially, populations are getting older. So it's an interesting space. So in the scope of the current project on CLOs, collateralized loan obligations, capital, why is that important to the market?
So CLOs have been a growing asset class for, at least for U.S. insurers. We have very good data on U.S. insurance investments. That's that's where the most transparency is out of any other insurance market in the world. We can see that, just over the last decade or so, CLOs have gone from, rounding to zero in terms of an investment up to now 4.5% of total assets held, and that's for life insurers, right? And that's 4.5% of approaching $5 trillion. So it winds up being a large amount of it's a large share. It's a non-trivial share of the U.S. life insurers portfolios. It's also, if you look at it in reverse, roughly speaking, so CLOs have multiple tranches that are issued. If you look at the AAA tranche, so the most senior, lowest credit risk tranche, about 20% of all outstanding CLOs are owned by insurers. If you look at the next three down, the AA, single A, and triple B, roughly half of all outstanding of those tranches are held by insurers, and then the double B is back to around 20%. So insurers make up a very important part of the investor base of CLOs, and especially in the investment grade mezzanine tranches from AA down through triple B.
And those mezzanine tranches, how much? What's their share of the total market? Because that's a big number. $5 trillion. It's huge.
Yeah. I guess again, there's still two ways of looking at it. From the perspective of total CLOs being the universe we consider, the majority of the dollars are in, or the plurality of dollars are in AAA. That's by far the thickest tranche. And so for any given CLO that's issued, the AA, single A, and triple B might both be about might be about 5% each. There's a residual tranche of, call it, around 8% at issue, and then all of the rest goes to the AAA. So most of it is AAA, but for insurers, life insurers anyway are invested, a little bit less than half of their total investments into CLOs are AAAs, and the rest is mostly AA, single A, triple B. They have some double B, some residual tranche, but so if you figure 4.5% in total, maybe 2% or so is invested in those mezzanine investment grade tranches.
Got it. How does the Academy's work differ from the SSG's work?
So just to level set a little bit, there is this, there have been a couple of different projects that started somewhat in parallel at the NAIC to tackle capital charges for CLOs. So as regulators have noticed that CLOs are making up a larger share of investment portfolios. So and as of today, a CLO capital requirement is the same as a corporate bond capital requirement of the same rating, but the risk characteristics are different despite that same capital charge. So as CLOs have become more material to the industry, regulators have wanted to look into updating capital charges. So with that objective, really two parallel projects were started that are somewhat merging together now. But the first project that started was SSG. That is the Structured Securities Group. It's NAIC staff who are working to set aside ratings. So as I said before, capital charges are based on ratings today. The SSG approach is to ignore the ratings of each CLO and instead run it through a model that is developed and maintained by the NAIC and reassign it to a different, effectively to a different rating. Although it's to a designation technically. So, but it would still map into corporate bond charges. So, for example, they might take a triple B CLO. There might be something the model sees in it that actually it seems riskier, and it might get mapped to a triple C bond rating, just as an example. Or it could go the other way too. Like a single A might turn into a triple A. So that's the basic SSG approach. The Academy approach is a little bit different in that our objective is to not rely on the corporate bond factors, but to come up with a new set of factors for CLOs. And then and once we have a new set of factors, we don't think we need to model each individual CLO going forward. At least that's our hope, is that we can use either a rating or some other simple combination of statistics. So it may be weighted average rating on the underlying collateral or credit support or something like this to categorize each CLO into a risk bucket. So that's the main difference. But I just want to make clear, this isn't a competitive process between the Academy and SSG. We're actually collaborating with the SSG. The SSG joins us in our weekly meetings on working through this, and they are helping us with our runs at the same time as doing the project that the NAIC has mandated that they do as well. So I think these two projects are merging over time.
Okay, so you're putting a final number on it ultimately.
Yeah. Like our output is a number. The SSG output is kind of reassigning a designation.
Right. Yeah. The as a former Wall Street Journal financial journalist, I think I prefer that outcome because I could see that would be a good story because there's going to be some big numbers, right, on the end of those assumptions. You mentioned the model that these instruments run through. I mean, is that a kind of stress test? What's it looking for specifically?
So again, I guess there are still these two separate modeling approaches, but I think, very roughly speaking, stress test is fair, but it's if you think of like when a rating is assigned, and obviously there are many people in this building who will know this a lot better than I will, but there is a AAA stress test effectively, and if you can pass that, you get to be AAA. There's a AA stress test that's a little bit, it's a little bit easier, and so on and so forth. The Academy model is built a little differently, so that we are, rather than trying to meet a specific threshold, we are just trying to quantify the risk at a particular point in the tail of the risk distribution. And right now, all of our, ultimately the regulators have to decide where in the tail, but for just purposes of coming up with some kind of number for now, we are using what's called the CTE 90, that's conditional tail expectation 90. It means, we run 10,000 scenarios, we throw away the best 9,000, we're just left with the worst 10%, and then we take the average of those, and that becomes basically our risk measure.
So you've heard the financial term for the next year there, the CTE 90. Yeah, CTE 90.
That's right.
We love it. I guess, kind of linked into that, another question that I have, I guess modelling these things and understanding that market was simpler before an event like COVID. How did that change your thinking at all, or the Academy's work, or any of these studies that's going on? Because it was a very sort of, a kind of black swan event. No one kind of saw it coming, but it definitely did have an impact on life expectations.
Sure. Yeah. Well, it had actually, I'll tell you, it did. But let me even dive in. There's a specific impact it had on CLOs that we've had to work through in this project. So, something that's true about CLOs and not corporate bonds is a CLO will never really have a default. Typically, in a typically structured CLO, there won't be a default event until the final maturity date, when there's not enough money available to pay principal. But there are many scenarios where if the underlying pool of loans is under stress, a CLO might defer interest payments. In particular, if it's one of these mezzanine CLO tranches. So, for example, if there's stress underlying, the triple B tranche and the double B tranche might stop paying interest to shore up cash to make the tranches above it safer. But when they do that, they bill that interest capitalizes. It's called payment in kind, or PIK. So effectively the principal that is owed to the investors into those tranches grows over time. Now, normally you would think if that's growing, that's probably a bad sign, and we should expect that some kind of loss will be experienced by those investors at some point. However, COVID provides this really interesting counterexample where during COVID, there was this immediate stress in the system. There were loans were being downgraded to triple C, or is it? So this was triggering just through the automatic structure of a CLO. It was triggering PICs. It was triggering deferral of interest on mezzanine tranches. But largely speaking, as we worked through COVID, those tranches wound up being money good. They had to pay out more than they would have because of that deferred interest. That there's interest on interest, but they were basically able to make those payments in the end. And our initially and our thought in modeling was to treat the deferral of interest, like if you failed to make an interest payment, that should tell us something. It should tell us you are probably about to experience losses. But COVID provides a counterexample to that. It's more complicated. If you have a severe stress followed by a quick recovery, tranches may defer interest and then recover.
That's really fascinating because when COVID happened, I think all our fears were that this is the mother of all financial crises, and you saw it in different asset classes. I know here on the commodity side at S&P, WTI crude going into negative territory, something that had never been seen before. But actually, from what you're saying, if I'm understanding it right, actually the insurance market, that it reacted in a way completely differently to what the big fear was, right? It was, and in many ways that probably proves all the stress test measures, all the guardrails that are put in place worked really well.
Yeah, and even in the financial crisis, CLOs came out largely unscathed, and frankly, the structures got more conservative, less levered after the financial crisis. Anyway, even during the financial crisis, they actually performed well. So there is a lot of history, and that kind of, I think that leads to a tension in the work that we're doing, and also just in the debate that is happening in the broader insurance regulatory community between those who, on the one hand, there are people who will point to the actual empirical history, which shows CLOs don't, historically, it's just, especially investment grade CLOs, it's just very rare to experience a default ever, even through some very severe stresses. On the other hand, all of the assets that actually underlie those CLOs, they're almost entirely below investment grade. Like, we know there is risk. We also know that over time, the recoveries after default on these underlying loans have been getting worse and worse. So there is this tension between, historically CLOs have not experienced credit losses. However, you can come up with reasons why they might in the future, right? Especially recoveries getting worse and interest rates rising, right? Which means all of the companies, these loans are all floating rate. The companies are borrowing at floating rate, which means it's getting harder for them to make their loan payments with higher rates now.
What sort of connection is there to broader money markets in the US with how these loans perform? Say what the Fed does, etc.
So they are all floating rates. So they are almost all floating rates.
Right.
So they pay SOFR plus a contractual spread. So as now the Fed is cutting again, so that that SOFR will quickly follows what the Fed does, which means the interest payments are coming down. It's also, but fortunately there is asset liability matching inside of a CLO. So all of the assets of a CLO, these bank loans or middle market loans, are floating rate. All of the debt tranches on most CLOs, the debt tranches that are issued are also floating rate. So mostly that's SOFR just passes through. Of course, the difference is there are more assets than liabilities in a CLO. So you might raise, let's say you raise $500 million for a CLO, you'll buy something like $460 million of loans, there's an extra 40. So it is slightly beneficial for the CLO structure if rates rise, and in that sense, assuming that rates rising doesn't also cause the bank loans to be more likely.
So that excess is like a buffer within the CLO, is it?
Yeah, and that is all effectively owned by what's called the residual tranche. So
right.
Whoever owns the equity in the CLO, if there's money left over at the end, they keep all of it. But they're also the first to lose money when there's losses on the pool of loans.
Got it. What resources is the Academy using to undertake this study?
So the academy is, the work is all done by volunteers. So we are
Wow.
like myself, yeah. So we're no one's, for better or worse, no one's paying us to do the work, right? So it's mostly actuary. It's all actuaries, and those who work at a combination of asset managers like I do, or who work at life insurers, or who work at consultants, or in some cases who are retired. And this is a way to stay connected to the profession, keep active, so that there's those are the people doing the work. But in addition to that, we've been very fortunate to get really great support from the broader community, including S&P. S&P has been hugely helpful to us. They've made available their structured finance team that we've been able to spend a lot of time with. Actually, the ACLI, so that's a trade group representing U.S. life insurers, has also been helpful. They own the model for corporate bonds. They've allowed us to use that to model the underlying loans, so that. Just in general, the whole industry. The CLO portfolio managers, risk teams across life insurers and asset managers have all made themselves available to us to help train up. Not every actuary on this group is necessarily came into this project having spent decades working on CLOs, right? There's a diverse range of backgrounds and experiences. So I think especially the broader community was really helpful in helping people on this volunteer group get up to speed.
So it's really sort of taken a village to pull this thing together. It's interesting though that you've managed to pull together such a broad spectrum of expertise from the industry. People must really see a benefit in this study then to commit that time.
Well, either a benefit in a study or a fear of it being done wrong.
Right. Okay. Yeah. On that question then, what could go wrong?
Yeah, well, if you get the capital charges wrong, it's bad in either direction, right? So if the capital charges are too high, you risk choking off this source of capital for CLOs, which in turn chokes off a source of capital for the underlying loans. And these are generally smaller companies. We don't. And again, I am not an expert on the finance side of these companies, but I would imagine having capital available is probably good for them. So So we don't want them too high. We also don't want them too low, because then you may see insurers take on excess risk by buying more of these than is appropriate for their portfolios, and then regulators will not have the advance warning of potential solvency issues that RBC is meant to give them.
It's a seat at the table that you want to have then, to have a stake in what those outcomes are. Yeah. Can you give us some details what's in the study?
Yeah, absolutely. So this is really important that we want, because internal consistency is important. We do not want, and there's this phrase that's been bandied about a lot recently called equal capital for equal risk. That is a directive from the NAIC at this point. So we want to find a way to model CLOs such that the whole framework is internally consistent, when we include especially corporate bonds, right? So we don't want CLOs to look cheap or expensive in capital terms versus bonds. So the way we do that, we are using that corporate bond model that the ACLI has given us access to, that was developed. They paid Moody's to develop it, and we've got that model. We are using it to run these 10,000 economic scenarios I mentioned earlier on the entire underlying pool of loans that sits inside of the CLOs. We then identify, so there's 10,000 scenarios. We have a statistical technique to identify 17 key scenarios that are all fairly deep in the tail. These are all bad outcome kind of scenarios. And we run each of those.
Give us an idea of some of these bad scenarios then.
There's.
Are we talking plague and?
So the model doesn't work exactly that way. There's no narrative to the model. Right, it's just a quantitative one. But the numbers are enough defaults that the defaults have never happened before, right? And that's important. The worst case scenario is not the worst case in the history. It's a forward-looking model where something much worse could happen, and we have to assign some probability to something much worse happening. And if we otherwise, historically, investment-grade CLOs basically don't default. It would be very easy if we weren't assigning
That's a really interesting concept, because I think that most people's misunderstanding of risk is that it's based on the last major risk event that the market saw, and it's not, is it? It's, as you said, it's actually
daily.
It's the worst
right
possible computation from what we would see in the data.
That's right. Yeah. So we take those 17 varying degrees of kind of worst that we could see scenarios. We run each of them through we run each of them through the waterfall structure, which is what we call just this idea that losses get distributed from the bottom of the CLO up to the top. So we identify where the losses are in each tranche of each CLO, and then finally, once we've identified those losses, we convert them into capital charges by applying a few other adjustments. Most importantly, taking out the amount of risk that is already incorporated in the reserves that insurance companies hold, and then seeing how much risk is left over for the for the capital charge.
This is a task to me that would seem like potentially AI could have a big impact in how, maybe not this study, but future studies are conducted, or the outcomes. Are you starting to see any of that? Does that play a part?
I this is a more mundane version of AI, but already some of the code that we have written has been AI assisted for this project, so it has found its way in. But I think the more
made it quicker, right, to do. Do you think?
Yeah. Oh, absolutely.
Right.
Absolutely, yeah. But in the sense of what we haven't done, which I think is kind of the more sexy version of AI, would be to have AI just kind of give AI the broad parameters and say solve the math problem. We haven't done that, right? The truth is we're trying, I think we're much more heavily constrained than something like a machine learning type of an approach would lead to, because we want to be consistent with what has already been done and what's already in the system, and that heavily constrains us. So we're not really playing in a sandbox where we're just trying to get the best, most precise measure of the risk purely. We want to be as precise and accurate as we can be with the risk, but subject to the constraint that we are taking an approach that is consistent with other areas within RBC.
So what you've just described, this document, this study, to me, this sounds like the most important document in financial services that's about to come out. I think that everyone needs to see this. So what will the public be able to? Will it be made public so that people can read this openly?
It will be, yeah. I'm not sure if it's the most important. I appreciate you saying that.
It's drum roll.
To some, there's surely someone in the world for whom this is the most important. I don't know about the broader world, but
So but everyone's insured. This is this is where I find it a fascinating subject. It's insurance is probably, after your home loan, the second most important decision you're going to make financially. Anyone's going to make. So I would say this. If you're going to read anything, read this.
I appreciate that. Yeah, thanks. Yeah, so it is all. Yeah, it's all public. Actually, most recently on September 8th, I think it was Monday the 8th, we presented an update on this study to the NAIC, and that is the entire presentation is public on the NAIC website. And we will have and on the American Academy of Actuaries website, and but that was a status update. Ultimately, we will have a full report that again will be made public. It will be as transparent as we're allowed to. There are a couple of vendors that we're using where we're not necessarily allowed to disclose the underlying assumptions that came from their data, but outside of that, every part that we legally can make transparent will be transparent to the public.
So it's going to be made publicly available. What else will the NIC do with it?
So that's a great question. The Academy is advising, but we have no authority to implement. That is all up to the NAIC and to the states. So we will present our recommendations, and then it's the NAIC. They might just say thank you. You all are brilliant. We're just adopting it just like this. They might adopt it with some adjustments, or they could completely discard it. Right? It's plausible that the SSG has this alternative approach that I mentioned, and while we're collaborating together on this approach, it's possible regulators say, you know what, the SSG approach is just a better way of doing it than the Academy. That will either way. I would expect 2026 to be kind of a key year for seeing how that turns out. The SSG approach was going to be implemented 2025 year end. It looks like that's getting delayed to 2026, just to give time. I think to give regulators the choice between the two.
Is there a scenario where they would ask you to make revisions or give you?
They certainly could, and we're trying to build that into the timeline. In order for 2026 year-end implementation to happen, we need to have the numbers finalized by April 30th. So we are, our goal is to have our next big report ready by January. So that gives time for, for a round of feedback and doing the work again. And of course, like there's no law of the universe that says the whole thing couldn't be delayed till 2027. I think there's a lot of, I think there's a lot of a lot of desire on the part of basically everybody to put this to bed in 26 if possible.
Early 26 then, that's the kind of key date there. Yeah. Great. Well, Stephen, thank you so much for coming into the studio here in London, and thank you so much for giving me such a comprehensive view of the work of the Academy, the NAIC, but also the importance of actuary globally and insurance. Everyone has it, everyone needs it. We should all understand it more. Thanks very much to our listeners for downloading this episode of the Look Forward podcast. You can find us on Apple Podcast Store, Spotify, YouTube if you so choose, and also the S&P Global.com website. Thanks very much. Bye-bye.